Hi, this is Bennett Tchaikovsky, and welcome to Bank Reconciliation. This disclaimer and copyright notice: the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2019 by Bennett Tchaikovsky. All rights are reserved and any distribution is strictly prohibited. So we're talking about today about bank reconciliations, and this is something where when I was first teaching accounting or coming back into it a few years ago, I was advised by my advisor to say, hey, we just don't have enough time for it to skip it. But then when I spoke with my future, as I was starting to talk with my former students, and they were kind of going and taking the upper division classes, they were kind of coming back to me and saying, hey, Tchaikovsky, you got to do bank recs. It's something we have to know. So here we are. So what exactly is a bank reconciliation? And this is can be any type of reconciliation. And really what it is we're taking an external statement, meaning that a statement that's being prepared by a third party, and we're essentially reconciling it with the records that we have on our books. And a couple different things here is that, do banks make errors? Yes, they do. Sometimes some banks open up two accounts for us unbeknownst to us. And different types of items that bank statements will be recording. So on the bank statements, there will be different types of items that we may not actually see in terms of our books, mainly chargebacks, fees, return checks, interest. And so chargebacks really relates to credit card charges. Bank service fees are those monthly fees that we end up paying. If there's a non-sufficient funds check, that's what we call a return check. And we also might have interest income. And at the same time, do we as accountants make mistakes? Sure we do. Absolutely yes. We are prone to error, and human error can oftentimes happen. Hopefully we're using a computer, so the chances of us making an error are that much less. But again, that's one of the things that we go through and do. We do make mistakes. And how do we really verify here that our employees are acting with integrity? So what's very important here, and this chapter usually kind of comes in with an internal controls part. And when you're talking about internal controls, what you're trying to do is you're trying to segregate the various duties. And this is the person who's collecting the money is different than the person who is depositing the money, who is different than the person that is reconciling our checking account at the end of the month. So again, this is a bank reconciliation, offers kind of like an independent check to make sure we're doing things the right way. If you are going into a business as an auditor and you find out, one of the main things that they will always say is, well, how often do you reconcile your bank statement? And if they're not saying at least monthly, there's a problem. So, and again, the purpose of the reconciliations is to balance our books to external records. We are going to do this right now here with bank statements to book balances. We can also, though, do it too with investment statements to book balances. And we can also do credit card statements to book balances. So again, it's not only bank or our cash account that we can actually go through and reconcile, but there are other accounts we can do so as well. So the way we're going to approach bank reconciliations is, the first step is we're going to determine the ending balances for the bank and for the books. So right here, bank ending balance, and then we have a book ending balance. So let's just kind of do this right here. Well, we'll get to that in a second. So that's the first thing I'm going to do. I'm going to have my bank ending balance in my book. Then what I'm going to do is I'm going to adjust the bank, and I'm going to adjust the books in terms of, there are certain items that will affect the banks, and there's going to be certain different types of items that will impact the books. What I've tried to do is to write you an example that covers everything. So what are the typical different types of items we're going to be adjusting that bank balance for? The first one is going to be for an outstanding check. What is an outstanding check? It is a payment that I've reflected on my books, meaning I sent the vendor a check, but the bank, that vendor has not yet deposited that check yet with the bank. So over here, this is a check that's written on our books, but is not yet cleared the bank. Another one is a deposit in transit. Well, excuse me. Well, good job, Tchaikovsky, to get some more sleep. So with deposits in transit, what is a deposit in transit? That is when I am I've made a deposit that's reflected on the company's books, but it has not yet been received by the bank. So I'm going to have to increase that bank balance. Lastly, I might have bank errors. Money's deposited to our account in error, or funds are withdrawn in error, meaning that there were things that happened to our bank account that did not relate to us. Most importantly is that we do not make journal entries for the banks. Rather, we are only going to be making journal entries to correct the books. So as I go through and adjust this bank ending balance, what I want to be going through and making sure is that I'm not doing those journal entries. I'm only going to be doing those for our books. So then what we're going to do is we're going to adjust our book balance for a few different items. So when a bank gives us interest income, it's typically going to be reflected on our bank statement. It's not something that we're going to be computing and recording on our books prior to receiving that bank statement. So over here, we're going to make sure that that interest income is reflected on our bank statement, that if there are any types of bank service charges, like if they're going to charge, if the bank will charge us $15 a month for keeping our account open, that also has to be reflected. Are there any book errors, meaning that did I record something wrong or incorrectly on my books? Then we also have non-sufficient funds checks. What does that mean? Well, it means that a client paid me, I deposited it and showed it as an increase to cash in my account. However, the bank rejected the check. So therefore, what I'm going to need to do is to adjust my book balance by decreasing my cash and reinstating the account receivable. So we're going to adjust the book balance, and then we're going to go make sure that the bank and the book balances reconcile after those adjustments. Lastly, we're going to prepare journal entries for any adjustments to the books. So the key thing to remember is when we get to the journal entry part, is that if we have our cash, or essentially our balance per our books, and if there's an increase to cash, or like a positive amount, say for interest income, if that is a positive amount, I'm going to be debiting cash. If the amount is a negative amount, meaning that, say, if I have a bank service charge, I will be crediting cash and debiting bank service charges expense. So let's go ahead now and get to our sample problem. So here we go. We have Senuri Inc., who is one of my favorite bank tellers. They received a bank statement showing that the total cash balance was $200,750. Balance per the books was $185,950. And then using the following information, we need to reconcile the bank account. So there's a lot of different formats in terms of doing bank reconciliations. Most of the time as we go through and we are looking at this from the perspective of your computer system or QuickBooks will be running some sort of reconciliation for you, or it has the ability to do that. But right here, what we're going to be doing is we're going to be showing here the first step, remember, is I'm going to be showing, let's go here to step one, is I'm going to determine the ending balances for the bank and for the book. So we have our bank ending balance, and then we have our book ending balance. So let's go over here. So my bank ending balance is going to be $200,750. And where am I getting that number? It's right from up here. Tells me that my bank ending balance, because I received a bank statement showing that my total cash balance was $200,750. So the next thing I'm going to go through and do is I'm going to say that my book ending balance here was $185,950. So my balance per my books was $185,950. And so let's just go here. This is where I'm getting these numbers from. So once I have this part here, okay, now what I need to do is I need to reconcile these so that at the end of the day, we have a reconciled balance where both the bank and the book ending balance will be the same. So let's go ahead and start with each one of these over here. So my first one here is that the bank statement showed interest earned during the month of $500. So what I'm going to do, and I want to do my journal entries last, the first thing I want to figure out is how do I go through and reconcile my bank account. So here, the bank statement is showing an increase of $500 as a result of the interest earned. So over here on my books, I'm going to show here a positive amount here for $500. And I'm going to call this a interest income. That's what that is. So that's going to be increasing my book balance. Now note, again, when the bank statement shows interest, that's already computed into this balance here. I therefore need to show this as an increase on my books. Next one, letter B, the bank statement showed a service charge of $25. Well, what does that mean? The bank took out $25 as my monthly fee. Therefore, what I need to do is I need to show this bank service charge on my books for the $25. Okay, so again, how we name it is up to your instructor. I would just call it, it's going to be an expense. So letter C. So the bank correctly cleared a check that related to supplies expense for $5,000. And so right here, I only recorded though $500 on my books for the supplies expense. So the bank correctly showed here $5,000 as a deduction basically on the bank's books. So on the bank, they showed a correct deduction of $500. On my books, though, I had only recorded $500. So to get from, and is this correct? The answer is no. The correct balance is going to be $5,000. So how do I get from what I recorded on the books to the correct balance? Well, here I'm going to need a $4,500 amount. So this is going to be 500 minus 4,500 is going to be equal to negative 5,000. So right here for this particular question, what I'm going to do here is I'm going to say, okay, I have here, when I have a bank error, what I want to first do is say, okay, what's on the banks and what's on the books? So right over here, the bank recorded properly $5,000. Here, I only recorded it $500 on the books. So to get to my correct balance of $5,000, I need an adjustment here for $4,500. So that's where that is coming from. So this is my adjustment. So I'm going to have here, and we're going to call this letter C to adjust for supplies expense. And how can this happen? Well, if someone is manually writing out the checks, they may have written out something for $500, but then they recorded it in the ledger for only $500. There's a lot of things you can do to prevent that, but do these kind of things happen all the time? Okay, so over here, letter D. So we're now going to our next error. So this is letter C. And now we're going over here to letter D. So here for letter D, I have here on my bank records, the bank correctly cleared a check for utilities expense for $7,000. SI incorrectly recorded $7,700 on its books for the utilities expense. So right here on my bank, I recorded here $7,000, which was correct. However, on my books, I had $7,700 as my initial recording. However, this is not correct because the ending balance should be over here of $7,000. Again, The bank correctly cleared the check for $7,000. I incorrectly had this over here at $7,700, so I know I'm going to have to adjust my books. So now I get to this question here. How do I get from negative 7,700 to negative 7,000? Well, if I add in 700 here, or negative 7,700 plus 700, I'm going to get to my correct balance of negative 7,000. So what I'm going to do here is for letter D, I'm going to have a positive amount to adjust for utilities expense. Okay. So again, when I'm dealing with bank errors, show the correct amount over here on the bank, whether it be on the bank or the books, will tell you where you need to adjust it. Right here, the bank correctly cleared a check so that I know that this 7,000 is correct. Right here, the bank correctly cleared a check for supplies expense for 5,000. So I know that the bank has done that properly. Okay, the next one here is letter E. The bank returned a check for 25,000 that had not sufficient funds. So what happens is I receive a check for $25,000. I deposit it to the bank. The bank turns around and says, we've tried to go to that bank and we tried to clear it. They didn't have sufficient funds. So what I need to do here is I need to show a reduction on my books for $25,000 because that amount never came in here. Now, is that money gone? The answer is, well, we have to decrease our books, but I will reinstate my receivable and then I will go ahead and try to collect that again from my customer. So this is going to be to record non-sufficient fund check. Okay. So that's my letter E. So we come up over here to letter F. The bank erroneously recorded a $35,000 deposit to SI's account. So there's $35,000 that should not have been deposited or put into this balance. So therefore, what I'm going to have to do is I'm going to have to remove that amount. So I'm going to show that essentially that deposit, and this is going to be over here. This is going to be letter E. So letter F, bank deposit. It's going to be letter F, bank deposit error. Okay, so the bank made a $35,000 deposit, which it should not have made. Okay, we'll make this a little bit, hopefully a little bit more clear in terms of what belongs to what. Okay, so that was letter F. So the bank deposited money that it shouldn't have, right? The money didn't belong to me. So I need to remove this from the balance. Letter G, the bank erroneously recorded an $800 withdrawal against my account. So in this case here, they deducted money instead of adding it, meaning I had to reduce it here. They reduced it by 8,000, which they shouldn't have done. So what I'm going to do here is I'm going to be adding this back. And this is going to be my bank withdrawal error. Okay. Letter H. SI had outstanding checks of $27,125 that did not clear the bank. So to reconcile my account, right, on my books, I've shown the deduction, or that's what an outstanding check is. I've written the check, I've reduced my books, but the bank has not yet cleared it. So what I'm going to do here is I'm going to call this here for letter H, and this is going to be my outstanding checks. Okay. And then finally, we have over here letter I. I mailed an $11,000 deposit that had not been received by the bank as of June 30th. Now today, in today's world, you'll kind of see things a little bit differently. But back in the day, if we're mailing a deposit or if we've made a deposit that's not reflected on our bank balance, meaning that we've put the deposit on my books, but it's not yet hit my bank, I need to add this in, and we're going to call this a deposit in transit. And this here is going to be for $11,000. So I've looked up, I've done A through I, and now what I'm going to do is I'm going to total these up to make sure that they balance. So over here, I have 185,950 plus 500 minus 25 minus 4,500 plus 700 minus 25,000. I get 157,625. Over here on my books, I'm adding up these various different balances. So my accounts are now balanced. I am now reconciled. So I've taken care of that part of it right here. And so I'm good to go, at least from this part here. When we actually go through and do a bank reconciliation using an account, what we're going to have to remember, and you can go through and look this up. Let me just pause real quick. So then we're back here with Tchaikovsky. So when you're over here and you're kind of looking at this, I just pulled this example up here from YouTube. What you would be doing over here in terms of YouTube is you would be kind of going through here and basically QuickBooks ends up doing this work for you. You're going to have your bank balance, which is going to be calculated for you because that's what you're going in here. You enter in the bank balance, which is going to be, let's see here, where you're going to be putting in your, okay, so my beginning balance here, and then you're going to be going through and inputting that in a bank balance. And then it's going to essentially go through here, this 32,403, and this is how you actually go through and reconcile this. You can learn QuickBooks very, very easily by watching videos online. I oftentimes recommend my students to learn QuickBooks, and it's something that you can do on your own. So when we do a reconciliation in real life, it's going to be a little bit different because over here you can see all the checks that the company's written. What I would be doing is I would be comparing this to my bank statement to make sure it's gone through and cleared. And then that would be helping me going through in terms of reconciling. Then I would know what my outstanding checks are. I would know all those other types of things. So going back over here to our sheet over here, so now we've gone through and we've reconciled our account. So the next thing I will need to go through and to complete is going to be the journal entries. So when I'm doing journal entries, okay, so I'm only going to be I'm only concerned with what is on my books. I don't care about the bank. I can't go to Wells Fargo and say, hey, book my deposit in transit. So what I'm going to do here is my approach when I'm doing journal entries is that these are going to be all at the month end. So this is all going to be as of 6/30/19. I'll start with the first one. And so my reference here, my first letter reference here is A. Now my rule is that if I have a debit, or if I have a positive amount, meaning I'm adding it in, that means over here I'm going to show this as an increase to cash. Okay, so if the amount is positive on my reconciliation, I'm going to show that over here as an increase to cash. So for every debit, I need a credit. Over here, I'm going to be recording interest revenue or interest income, okay, for the 500. Now to kind of see if this is making sense, what we can do is go over here to our favorite T account. We can say here, we've got the A, the assets equals my liabilities plus my owner's equity, expenses, revenues, debit, credit, and this here is my assets are equal to my liabilities plus my owner's equity. And again, if you haven't watched it, this is the first video you're ever watching, thank you. But at the same time, when we're recording assets, we do so with debits because it's on this side. We show increases to assets with debits, decreases to assets with credits. Same thing with expenses. We're going to debit our expenses. With liabilities and equity, we show increases to those accounts with credits, decreases with debits, and we're going to record revenues generally with credits. So this makes sense with my T theory of accounting. Last thing I'm missing here for my journal entry is to record interest income. Okay, so I've gone through and done that. My next one here is for my reference is going to be for letter B. Also here, my date of my reconciliation is June 30th, 2019. However, now this is a negative amount. So here I'm going to be crediting cash for 25. And when I go through here and I'm crediting cash for every credit, I need a debit. So what I'm going to call this here is like bank services or bank service fees expense, whatever I'm going to call that particular account, bank service charges, bank services expense. And this is also going to be here for $25, right? This is a cost of me having my account open. How do we record expenses? We do that with a debit. So we're here to record bank service charges. Okay. So my next one here is a negative $4,500 to adjust for supplies expense. So because this is a negative amount, I'm going to show this over here as a credit to cash. Again, this is letter C. This is going to be 6/30/19. And here for every credit, I need a debit. And this over here is going to be to supplies expense. Now, if we don't remember what we just went through and did with that supplies expense, over here, the bank properly recorded it as a negative 5,000. However, I only recorded it as a negative 500. Therefore, I need another $4,500 worth of expense, which is what I've done right here, okay? And this is here is to be recording properly record supplies expense. Now, in reality, what I would more than likely do is I would go through here and I would essentially probably zero out, or I would void my original transaction here, and then I would re-record it at the proper amount at 5,000. But that's not what we're asked to do today. We're just doing this here. This is fun. So that is that one particular item. So that's letter C. Letter D, I needed to adjust for utilities expense. So here in this case, I've got a positive amount here for cash. So what I'm going to do here is I'm going to be debiting cash for the 700. So this is letter D. This is 6/30/19. For every debit, I need a credit. In this one here, I'm going to be crediting utilities expense. Here to properly record utilities expense. Now, you might be saying, Tchaikovsky, this is an expense, therefore it must be a debit. Well, however, if you look at this one, right, the bank, we actually recorded too much expense. Okay, so we had 7,700, it should have only been 7,000. So that's why in this case right here, for my adjustment, I'm going to be crediting utilities expense. So right over here to my next one, to record a non-sufficient funds check. So it's a negative amount. So here for letter E, I'm going to be crediting cash for 25,000. Okay. So for every credit, I need a debit. Now, what a non-sufficient fund check is that a client paid me for services that I performed, or it's an unearned revenue amount, but generally they paid me for services. So what I need to go through and do here is, does the client still owe me for services? And the answer is yes, they paid me with a bad check. So here I'm going to be debiting accounts receivable. Okay. So that is bank reconciliations. Again, every place does it differently. But again, you want to start over here by comparing the bank to the book ending balance. I hope you enjoyed this video here today. And I want to thank you for watching this video. Please do not forget to like and subscribe, and I appreciate your comments. Please keep them coming, and have a great one. See you on the next video.